In today's video, I want to take you back to one of the most brutal economic decades in American history. Because what happened in the 1970s is not just ancient history, it is a roadmap. And right now, with oil prices spiking because of the Strait of Hormuz, with core PCE sitting at 3.1%, with unemployment ticking up to 4.4%, and the Federal Reserve completely paralyzed, I am telling you, the parallels are impossible to ignore. So today I want to show you the 3 investments that not only survived the 1970s stagflation crisis, but actually made people wealthy. And I also want to show you what turned to absolute dust. Because if you are holding the wrong things right now, you need to hear this. Listen, the 1970s were not a minor rough patch. They were a full decade of economic disaster. Inflation peaked at over 14% in 1980. Unemployment climbed to nearly 11%. The Dow Jones Industrial Average opened the decade at 809 points. It closed 1979 at just 839 points. Think about that. After 10 full years, you made almost nothing. And when you adjust for inflation, the S&P 500 lost approximately 50% of its real value over that decade. 50%. Gone. Not in a crash, not in a panic, but slowly, quietly, over 10 years, while the government kept telling everyone the economy was fine. Sound familiar? I am just going to say it. The writing is on the wall. And if you are not paying attention, you are going to wake up a decade from now asking yourself what happened to your money. So let me give you the setup quickly, because context matters. The stagflation of the 1970s was triggered by 2 massive oil shocks. The first in 1973 when OPEC cut off oil exports. The second in 1979 following the Iranian Revolution. Oil prices quadrupled almost overnight. And what did that do? It drove up the cost of everything: food, transportation, manufacturing, housing. At the same time, economic growth was grinding to a halt. So you had high inflation and high unemployment happening simultaneously. Economists used to say that was impossible. They called it a contradiction. The 1970s proved them completely wrong. Now I want you to keep in mind what is happening today. WTI crude has now breached $90 a barrel. The Strait of Hormuz is essentially at a standstill. Core PCE inflation is at 3.1% and has been above the Fed's 2% target for 5 consecutive years. The unemployment rate is on an upward trend, and the Fed is completely stuck between a rock and a hard place. We are not in 1973 yet, but the fingerprints are there, and I want you to be prepared. So let us get into it. Here are the 3 investments that survived, and then I will show you what turned to dust. Investment number 1, gold. I want to show you this. In 1970, gold was trading at approximately $35 an ounce. By January of 1980, gold had risen to $850 an ounce. Let me say that again, $35 to $850. That is a 2,300% gain in nominal terms. In real inflation-adjusted terms, gold delivered approximately 9.2% annualized returns per year during the heart of the stagflation period from 1973 to 1982. There was simply nothing else that came close. But you might say, Brian, why? Why does gold do so well when everything else is falling apart? Let me explain it as simply as I can. Gold is not tied to any government. It is not a promise. It is not a piece of paper that a central banker can devalue overnight by running the printing press. When the Federal Reserve starts printing money faster than the economy is growing, the purchasing power of every dollar in your wallet quietly shrinks. What we call inflation. But gold does not care about the printing press. Gold just sits there, and its value relative to that debased currency rises. It is as simple as that. In the 1970s, when Nixon ended the gold standard in 1971 and the Fed lost all discipline, gold did exactly what it has always done throughout human history. It preserved wealth while everything else crumbled. And here's what is relevant right now. The Federal Reserve's balance sheet is expanding again. M2 money supply. That is the total amount of money in circulation is rising. Oil is rising. Inflation expectations are rising. And gold right now is already responding. But the 1970s playbook tells us that we may still be early. Investment number 2, commodities, and specifically energy and agriculture. Take a look at this chart. The S&P GSCI index, which is basically a broad basket measuring commodity investment performance, returned 586% over the decade of the 1970s. 586%. Now here is why that happened. Stagflation is fundamentally a cost crisis. The cost of raw materials goes up, the cost of energy goes up, the cost of food goes up. And the companies that produce those raw materials, that extract that oil, that grow that corn and wheat, They benefit directly because the price of what they are selling is going up while the rest of the economy is suffering. Look at what happened to farmland. According to the U.S. Department of Agriculture, the average price of American farmland was $137 per acre in 1970. By 1980, it had risen to $737 per acre, and that does not even account for the income from the crops themselves. Because at the same time, corn prices nearly tripled, wheat prices quadrupled, beef prices doubled, and oil prices rose over 1,000% during the decade. Listen, I know that people look at oil and commodities and think of them as volatile, speculative investments, and yes, they can be, but you have to understand what is happening right now. The Strait of Hormuz, one of the most critical shipping lanes on the planet, responsible for roughly 20% of the world's oil supply passing through it, is essentially at a standstill. Only 2 oil tankers passed through yesterday. 2. And WTI crude has already breached $90 a barrel. If this situation escalates, the energy companies, the commodity producers, the agricultural players, they are sitting in the exact same position that they were sitting in during the oil shocks of 1973 and 1979. History does not always repeat, but it rhymes. And right now, the rhyme is getting louder. Investment number 3, real estate with an important qualifier. Now, I want to be honest with you here because real estate in the 1970s is a more complicated story than gold or commodities. The FTSE Nareit Index, which tracks real estate investment trusts or REITs, gained 100% in total return between 1971 and 1981. Real estate as a broad asset class delivered approximately 4.5% in real annualized returns during the stagflation period. Compare that to stocks and bonds, which both lost purchasing power over the same period. So yes, real estate held up. But here's the important qualifier I mentioned. Not all real estate. It depended heavily on what kind and where. Farmland and commercial real estate with inflation-linked leases did extremely well. California residential real estate tripled in value over the decade as population exploded. But in other parts of the country, where local governments imposed rent control and capped how much a landlord could charge, real estate was a terrible investment. Because if you cannot raise rents in line with inflation, your income stays flat while your costs go up. The property becomes a liability, not an asset. And here's what I want you to understand about why real estate works during stagflation in general. People need housing regardless of what the economy is doing. They need food storage. They need logistics warehouses. The demand does not disappear just because the stock market is struggling. And in an inflationary environment, the replacement cost of that building, the cost of lumber, concrete, labor, it all rises, which supports property values. Rents rise with inflation, and that rising income stream is exactly what you want when the purchasing power of a dollar is being systematically destroyed by money printing. Right now, rents across the United States are still elevated. The cost of construction is still elevated. And with housing supply constrained, the fundamentals for certain types of real estate, particularly income-producing properties and residential rentals in supply-starved markets, are structurally supportive. But you may ask, Brian, if those 3 investments did so well, what exactly turned to dust? Let me show you. 2 things destroyed investors in the 1970s. Stocks and long-term bonds. The mainstream financial media, the same way they do today, kept telling everyday investors to hold a balanced portfolio of 60% stocks and 40% bonds. Stay the course, they said. Diversification protects you, they said. And it was propaganda. It was simply not true in a stagflationary environment. The S&P 500, as I already told you, lost roughly 50% of its real purchasing power over the decade. The Dow went from 809 in January of 1970 to 839 at the end of 1979. Think about that, 10 years. And you barely moved, but you did not actually break even because inflation was eating your purchasing power the entire time. The Dow was a disaster in real terms. And growth stocks, they were absolutely obliterated. High-flying technology and growth stocks that were trading at lofty valuations got absolutely crushed. When inflation rises and interest rates rise, the future earnings of a growth company become worth less and less in today's dollars. The math simply stops working. And I want to point out that today we have the most expensive stock market valuations in history. The technology sector is priced to perfection. That is a really uncomfortable thing to think about when you look at the 1970s playbook. Now, bonds. The 10-year Treasury note yielded about 5.5% in the early 1970s. Sounds decent enough, right? But inflation was running higher than that. So you were actually losing purchasing power every single year while thinking you were being conservative and safe. And then as inflation surged, the Federal Reserve was forced to keep raising rates. And when rates rise, existing bond prices fall. By 1981, 10-year Treasury yields had soared to over 15%. Anyone who had purchased long-term bonds in the early 1970s had been absolutely destroyed. In 1979 alone, long-term government bonds lost 8.6%. We are being told by politicians and mainstream media that we are living in a period of low inflation and a strong economy. I have a healthy amount of skepticism about that. Right now, core PCE inflation is at 3.1%. The Federal Reserve has been above their 2% target for 5 consecutive years. 5 years. And they still project only one interest rate cut this year, even as their own inflation forecasts keep rising. That does not add up. And the Federal Reserve's own updated projections show they now expect core PCE to end 2026 at 2.7%, revised higher from their December estimate of 2.5%. They keep moving the goalposts and pretending they are winning. Listen, here is the real story versus the mainstream story. The mainstream story is that inflation is largely under control, the labor market is stable, and the Fed has everything in hand. The data tells a different story. 92,000 jobs were lost in February. That is not a strong labor market. That is a labor market that is deteriorating. The unemployment rate has been on an upward trend since 2023 and just ticked up to 4.4%. Oil prices are spiking because of a geopolitical crisis that has no clear resolution. The Strait of Hormuz is nearly closed, and core inflation is still running at 3.1%. That is not a recovery. Those are the conditions for stagflation. And the 1970s proved what happens to the average investor who is not positioned correctly when stagflation takes hold. They are living in ignorance, living in bliss, and the data is right there for anyone willing to look. Now let me give you the projection, the warning, because that is the part that actually matters. If oil prices remain elevated because the Strait of Hormuz crisis does not de-escalate, and there is no sign right now that it is going to, then the inflation that the Federal Reserve is currently struggling to bring down is going to get meaningfully worse. At the same time, the labor market is already weakening. Companies have been cutting jobs in manufacturing, in transportation, in healthcare, and across the technology sector. The Challenger job cut report showed transportation layoffs up 872%. Manufacturing job cuts up 143% compared to the same period last year. Those are not small numbers. If those two trends continue, rising inflation on one side and a weakening labor market on the other, you get stagflation. Not the theoretical kind, the real kind, the 1970s kind. And the investments that worked in the 1970s, gold, commodities, income-producing real estate, are the same investments that the historical data tells us work when that economic combination takes hold. Meanwhile, long-duration bonds and richly valued growth stocks are exactly what the 1970s playbook says should be approached with extreme caution. I am not telling you to panic. I never tell you to panic. But the data is what it is. And the trend, take a look at it. It is unsettling. It is moving in the wrong direction. And if this trend continues, we are going to be in a very different and very uncomfortable economic environment a year from now. The writing is on the wall. I showed you the data. You can let me know what you think. Subscribe to the channel for daily updates. I cover this stuff every single day because you deserve to know the truth and not the propaganda. Thank you so much. Have a very nice day. Take care.